Good morning, and thank you for joining us today. My name is David Talbot, Managing Director and Head of Research here at Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on uranium today. We will hear from Lotus Resources Management, including Keith Bowes, Managing Director. During today's webinar, he will provide an outlook and overview on the stock. Then we will take some questions. You can type your questions into the chat box at any time, and we'll get to as many as we can. But before we kick things off, first we need to discuss the fine print. During this Lotus webinar, forward-looking statements may be made. I would direct listeners to the company's forward-looking statements outlined on page 2 of the Lotus Resources corporate presentation, and that can be found at the company website, lotusresources.com.au. For Red Cloud Securities, I'd highlight this webinar is for informational purposes only. It should not be considered a solicitation or recommendation to buy or sell securities. We note that this call does not consider the particular situation or needs of individual investors, and participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located on the Red Cloud website for specific disclosures on Lotus Resources. Now, before Keith steps up, I would like to say a few words. Uranium prices have really been on a tear in 2021, more specifically since early August. While 30 to 32 bucks has been the normal range for most of the year, the UX broker average price peaked at 51.12 on September 17th. Now, we do believe this movement was due to both uranium price trading volumes and speculation. And this activity really spurred a run on the uranium equities. And as usual, with periods of stark volatility in the commodity price, we see investment risk-reward played out in the markets. Producers were up sharply, about 42% month over month, but explorers and developers like Lotus were up more, between 50 and 60 on average as a group month over month. The Sprott Physical Uranium Trust issued $245 million US in equity through early mid-September, and it purchased about 6.5 million pounds in the market, and that drove prices up from 30 to 40 bucks. Then Sprott decided to increase its shelf prospectus from 300 million to 1.3 billion, leading to additional speculation that it would be raising more equity and thus buying a lot more uranium in the market, and I believe that is playing out. But we also caution too much too soon. We love to see a more sustainable rise in the spot market, so we don't get these rapid pullbacks in uranium prices. We have seen the UxC broker average price fall by about $6 a pound over the past 6 sessions, including by 4.25 on Friday alone. So over the past week, because of that, most stocks appear to be off. Uranium stocks appear to be off between 10 and 15%. Now, over the long term, we do expect Sprott to provide a re-rating in the spot uranium market, but I also believe that long-term contracting is the most important driver. The world here uses 177 million pounds of uranium annually. That is the demand you want to focus on. So as spot and term prices both rise and converge, we do believe that long-term contracting will increase as the nuclear utilities come in to buy. Bottom line, we still like the fundamentals for driving uranium prices higher, and with disinvestment in the sector over the past several years, there has been lack of exploration and discoveries. New mines will be needed over the next few years to replace mine closures, let alone cover demand in uranium growth. So I think that's a good segue into how Lotus Resources can help solve this problem. And with that, I now turn it over to Keith to update the audience on the company.
Thanks very much, David, and thanks very much for the introduction. So welcome, everybody. And as David has mentioned, my name is Keith Bowes, and I'm the Managing Director of Lotus Resources. Lotus Resources is an Australian company. It is listed on the Australian Stock Exchange, but also earlier this year, we actually completed a listing on the OTC. So we're listed on the OTC QB under the ticker LTSRF. Now, Lotus Resources acquired the Kayelekera uranium project, which is a uranium project located in Malawi in Central Africa in about March of last year. As David has already mentioned, just some of the comments I may be making in this presentation, just to cover ourselves, is our forward-looking statement, which can also be found on our website as well. So normally the first question I get asked about is, why did Lotus go about acquiring the Kayelekera asset? What is it about Kayelekera that is unique and excited us about it? I think there's a couple of points to talk about. First of all, we must recognize that Kayelekera is a proven uranium producer. So it produced about 11 million pounds between 2009 and 2014. And what was important for us was that all of that product was accepted by the conversion facilities in the West. So that was at Rano, at Cameco, and at Converdyn as well, and obviously sold on to the utilities. So why is that important for us? Well, we look at that as that when we go out and try and negotiate some offtake agreements with the utilities, we'll be talking about a product that they've already treated or already processed and therefore know, and we think that gives us a leg up in terms of some of our other peers. It's also important to note that the existing plant itself is capable of producing somewhere between about 3 and 3.3 million pounds per annum of uranium. Now, when we look at our strategy in terms of how we want to restart the asset, we have no plans to increase the production rates. So we're quite comfortable with that 3 million pound production rate. What that means for us is that when we go to restart the asset back up again, it is a relatively low capital cost required to do it. Based on the scoping study that we announced to the market in October of last year, we feel, or we believe, that somewhere around $50 million is what is required to be able to restart this asset back up again. One of the other things that we recognize as being important is that because it's a brownfield asset that's operated previously, that doesn't require any expansions, we believe we can bring the production back on relatively quickly, and therefore we can participate or benefit from the current cycle, the uranium cycle that has just started. Now, we also looked at not only the asset itself, but what is the other potentials with the package that we bought. And when we acquired the asset of Paladin Energy, not only did we get the mining license in the plant, but we also got a number of exploration licenses as well. So Kayelekera itself is a resource of around 37.5 million pounds. There's only been very limited exploration over the last 15 or 20 years or so. We did a review of some of the historical data, and we believe there's some targets out there that will assist us in terms of growing the exploration or growing the resource as we move forward. I'd also like to touch on one other small thing as well. As part of our review, we also identified a rare earth anomaly that sits about 2 kilometers to the north of our existing pit. This rare earth anomaly called Melenji Hills has got some real attraction for us, and we plan on doing a little bit of work about that as well. And I'll talk about that in one of our future slides. So just whereabouts are we in the market, and whereabouts do we think Lotus sits at the moment? Well, in our opinion, we think we're sitting in quite a perfect storm at the moment. There's a number of short-term and a number of longer-term catalysts out there that are driving the market. I think David gave a really good summary of how he sees the spot physical uranium trust, and we're in total agreement with him. They've been very, very aggressive over the initial period of time, and we expect with their additional raising, the $1 billion extra that they've raised, they will continue in the short to medium term to be aggressive. And we've seen that in the price rise that David mentioned, going from around $32 per pound up as high as 51 last week, and dropping off a little bit this week or over the last week or so to around the $44, $45 per mark. So Sprott is an important player in the market, and we would expect to see them continuing to contribute to the increase in the uranium price. The other topic, of course, is to do with zero carbon emissions. There's a lot of conversations going on in both the US and Canada and Europe, and also in Asia and Australia as well. And any conversation that is going on always has to include uranium as being the only sustainable zero carbon baseload energy source out there. So in the longer term, we see that being a very significant player for the uranium market. Another thing we also identify is obviously the electrification revolution. I think it's common knowledge that as any country's GDP increases, the electricity demand also increases, and we would see uranium being able to benefit from that as well. When we start to look forward in terms of the supply and demand, we also recognize there is a significant imbalance coming up. And even under the most conservative calculations, we estimate there's a deficit of around 30 million pounds in the market by 2024, and that this could grow to around 60 million pounds in 2028. We also recognize in the conversations that we've had with the utilities that a number of the utilities went into the market and signed their long-term contracts in sort of 2008, 2009, 2010. And some of those long-term contracts are up to 10 years in length. So a number of the utilities are starting to come off contract at the moment. And we expect them, because of their conservative outlook, let's say, that they would want to go into further longer-term contracts to ensure that they have the supply going forward. And I think the higher prices we're seeing in the spot market have perhaps nudged them to go into these contracts a little bit earlier than maybe what they first anticipated. The last comment I'd just like to make, and I think it's been made by a number of the developers and certainly the explorers out there as well, even though we are extremely encouraged by the increase in the spot price that we've seen, as I mentioned, going up to $51 per pound. If you speak to most of the developers out there and most of the explorers as well, we still think that the current pricing is probably still a little too low to encourage new production. Most developers and explorers are looking for spot prices, or at least term contracts that they can enter, that are probably sitting in the $60, $65, or $70 sort of range. So I think there's still some movement in that spot price that needs to come prior to anyone committing to any contracts. One of the things I did mention on the introductory slide as well was just to talk about why Kayelekera was important for us in terms of being a first mover. So it's got a relatively quick time to come back online again. And that's really important for us. And the reason why I say that is when we did a review of all the projects out there, realizing that when the uranium cycle does start, you want to be in the first group that can actually participate and come online again during those high prices. How many companies out there have actually got assets that are on care and maintenance that can come online relatively quickly? And our review showed there's about 6 companies out there that have got assets that meet this criteria. Obviously, Cameco is a really big one out there with MacArthur River and Rabbit Lake. Paladin with their Langer Heinrich project in Namibia. And then we talk about ourselves, Lotus, with our Kayelekera project. And what was really interesting and really important for us is that the Kayelekera asset is the 4th largest producer that can come back online in a relatively short period of time. Other companies out there that also have the capabilities include Energy Fuels, Boss, and Peninsula Energy as well. But I think what was really interesting as well, when you look at the data, and you'll see the line over there where we talk about the market cap, we think that Lotus is actually relatively undervalued compared to our peers. We have a market cap of around $235 million compared to, say, someone like Paladin at 1.7, Energy Fuels at 1.1, and even Boss Resources at $480 million. So we believe we're undervalued, and we think there's a lot of opportunity for share price growth as we move forward. Just to quickly paint the picture of where we are at the moment. So as I've mentioned previously, a proven £3 million per annum producer. It has the infrastructure on site such that we can treat somewhere between 1.4 and 1.5 million tons per annum. We've also recognized that since the asset closed down in 2014, there has been a number of new developments in technologies that we think are applicable to the Kayelekera process. And therefore, we think we can improve the project economics over and above what it was operating at previously. It's also important to notice that the majority of our licenses are in place. So we have our environmental license. We announced to the market a few weeks ago that our mining license has been extended for another 15 years. And we've also had a number of our exploration licenses also renewed. So in terms of licensing and permitting, there's a number of small or minor permits that we still require before we can restart, but we see no issue of getting those in place. And then the last point as well, just to re-emphasize, with the exploration, we do have multiple near-mine untested targets that we think we can use to grow the resource and extend our eventual life of mine. So what is our pathway to production? How do we see Kayelekera coming back online again? Well, the first thing I want to talk about is the scoping study that we announced to the market in October of last year. So this was the scoping study that identified that circa $50 million was required to refurbish the plants and bring it back online. But what was really important out of that scoping study was that we made the assumption, first of all, that we would operate the plant in exactly the same way that Paladin did. And why did we do that? Well, we did that so that we could use all of the historical operating data that they generated between 2009 and 2014. So things like throughput rates, reagent consumptions, availabilities, utilizations, all of those figures became available for us. And the scoping study that we put out was based on those real figures. So we're very, very confident when we talk about the production rates that we generate, and we're very, very confident when we talk about the costs that we have for it. So for example, our scoping study identified a C1 cost of around $33 per pound when we were producing 2.4 million pounds per annum. But what we also used the scoping study for was to do a sensitivity analysis. So what we did is we used the discounted cash flow models and the various inputs into that to understand what are the key cost drivers and what are the key value drivers for the project. And on the back of that work, we've identified 4 different areas that we selected and have done more work on that we think are going to add value to the project. And those include things like ore sorting. So ore sorting is a technology that allows you to increase the grade of the feed material prior to feeding into the main plant. We had a look at the power supply. We currently run off diesel gensets. Are there some other alternatives out there that we can look at, including renewables, including connecting to the national grid? We also recognize that acid consumption and acid costs are a significant portion of the C1 costs, are the ways that we can recover acid, recirculate acid, and make better use of the acid. And we've got a lot of work going on there as well. And then the last thing that we identified is the tailings dams. So there's an existing tailings dam on site that has the capacity for about 5 to 6 years storage. At that point in time, we would then have to move and build a new tailings dam, which we know is relatively expensive. We're looking for some alternatives there, including input disposal, that we think will be a cheaper option for us moving forward. And what the idea is, we're working on all of those studies at the moment, and we've announced quite a few of the results from them already to the market. The results or the outcomes from all of those studies will then feed into our feasibility study, which we announced we have just started now. And the feasibility study itself will actually be announced to the market in 2022. So I just want to talk a little bit more about the specific things we're looking at. And ore sorting is a really important one for us. So I just want to emphasize though that it's not required for us to recommence production. The base case that we have for the project is still very, very strong, but this ore sorting technology allows us to have some additional benefits moving forward. Now, ore sorting, for people who are not familiar with it, is a technology that's been around for a number of years in the recycling industry. It moved into the mining industry about 5 to 8 years ago or so, and has made some significant advancements in that period, and is now installed at many, many facilities here in Australia, looking at nickel, looking at gold, looking at manganese, and looking at iron ore as well. We've done 2 sets of test work at Steinhardt, which is the company that we've selected for the ore sorting technology. Been really, really encouraged with the results. We demonstrated that we could feed a 1,000 ppm material into an ore sorter and come out with a product that has 2,000 ppm in it, which we can then feed into our main plant. Now, what does that mean for the project overall? Well, for one thing, we could look at just generally increasing our annual production rates. So as I mentioned in the scoping study, we had a production rate of about 2.4 million pounds per annum. By incorporating ore sorting, we could easily increase that to 3 million pounds per annum. Another one that we can have a look at, where I think the ore sorting technology is particularly significant, is with regard to extending our mine life. So within our scoping study, we had a look at one of our scenarios where we started to treat the lower grade material that is currently in stockpiles on surface or will be generated as we mine the higher grade material. Now, those stockpiles have got material that could be fed to the plant for about 6 or 7 years or so. We believe that by putting the ore sorting technology onto those materials that grade somewhere between 350 and 450 ppm, we could increase the grades to maybe 700, 750 ppm, which become highly economic feeds for the plant, and we then start current 8 years, which is our base case number, up to 11 or 12 years life of mine, and then with our exploration success, grow that even further. One of the other things that we've recognized with ore sorting as well, it does allow us to decrease our operating costs. And this can be done in 2 ways. It either dilutes our fixed components. So if we increase our production rates to 3 million pounds, we dilute the fixed components of our cost. But also we've seen reduced reagent consumptions, when we do leaching on the concentrates produced by the material, by the ore sorter. So there's some significant benefits for us there as well. The other area I've mentioned is that we're looking at power supply. So at the moment, the plant is operated off diesel gensets. We've spent some time looking at some alternatives. We believe, for one, that we can connect to the national grid. There's a substation about 50 kilometers away or so from the plant that we can connect onto. But we do recognize, first of all, the availability of power in Malawi and the reliability of power in Malawi is relatively low. So we need to find some alternatives that could come in if we lose connection to the grid. And we've had a look at two things or three things. We've had a look at taking power off our acid plant. So we have an acid plant on site. We know an acid plant generates a lot of heat as it converts the sulfur through to sulfuric acid. We can retrofit a steam turbine onto the acid plant and recover power from that. Now, our initial calculations with our vendors and our consultants have showed we can get somewhere between 2 and 2.5 megawatts of power off our acid plant. And that's 25% of our total power demand. So when we start the plant back up again, theoretically, we can get 25% of our power for $0, which is really, really attractive for us. We also want to have a look at wind and solar, so the two main renewable options as well, incorporate those, and then use the diesel gensets as backups. Now, diesel gensets, we know when they were operating, produced power at about 28 to 32 US cents per kilowatt hour. We think by implementing this hybrid solution, we will be able to at least halve our costs. So maybe 15 or 16 cents per kilowatt hour generated. Just want to talk a little bit about the exploration as well. So as I've said, Kayelekera already has a resource, an existing resource of 37.5 million pounds, previously produced 11 million pounds. So it had about a 50 million pound endowment. There's been very little exploration done in the last 15 or 20 years or so. So we did a review of the historical data, and we implemented or initiated a 5,000 meter RC drilling program about 2 months ago. Now, that drilling program is primarily focused on expanding our uranium resource. So we're looking at drilling in some of the little satellite deposits or satellite areas that we identified from the radiometrics that have a similar radiometrics signal to Kayelekera, similar geology types as well. They sit about 2 to 3 kilometers to the south of the pit. We've done some drilling in those areas, but probably more importantly, we identified when we looked at our geological models and looked at our block models of the resource, there is a potential to grow the resource further around the pit such that it extends outside of the existing pit shells. So when we do the feasibility study, hopefully we can push those pit shells out further, collect material that can then go into the production schedule. So we're focused on that at the moment. We also recognize, as I mentioned, we have these exploration licenses. We're doing a review of all the historical data there as well. And there may be an opportunity for us to do some drilling on these exploration licenses next year. And of course, as a company, we've also got an eye out for any other interesting tenements that we think may fit our bill as well within Malawi. So we're having a look at some other grounds as well. I just want to quickly come back to this Malenji Hills, this rare earth oxides as well. So these rare earth anomaly was initially identified by Paladin when they were doing their regional uranium exploration work. We came across the data last year, did some of our own field work last year. We did some mapping, some geophysics, and we did some trenching as well. We took a number of 1 meter composite samples from the trenches and sent those off for assay at the labs in South Africa. And I was really impressed with the results. We were seeing total REO grades in those 1 meter composites in the mineralized samples, averaging about 8% and going as high as 16%. But importantly, there was a significant portion of the critical rare earths as well. So up to 3.4% critical rare earths and averaging about 1.5, 1.6%. And when you look at those critical rare earths, it was really important to recognize that the major elements that made up the critical rare earths were neodymium and praseodymium. And we know that neodymium, praseodymium, dysprosium, and terbium are the essential elements for the manufacture of permanent magnets. And again, we know that permanent magnets themselves make up about 90% of the value of the rare earth market. So there's a real opportunity there for us to generate value for the company. We're doing a bit of drilling there at the moment. We've done some more trenching and some more mapping and some more geology. We're going to be getting some more results from those. And once we understand the size of the rare earth footprint, the depth of it, we can then decide how best we can generate value for the company from that. I just want to talk on one other topic as well that's really important for us. So environmental, social, and governance. So these are ESG or sustainability issues. First of all, we recognize that being in the uranium market or in the uranium production space is really, really important that uranium does form part of the future energy fold. And we want to be talking about that and trying to educate our shareholders as well about that. But the other thing we recognize, of course, is that we are in Africa. Malawi itself is a very, very poor country. And anything that we can do to assist the local communities, improve our social license to operate are very, very important things. So we initiated a process about 3 or 4 months ago. We've brought in an ESG consultant to help us, and he's helping us work through all of these issues to understand how we can develop the project, how we can report to our shareholders, report to future shareholders, and maybe even when we go into our investments and when we look at signing contracts and all those kind of things, we can present how well or how Lotus and Kayelekera is going about its ESG work. And then really just to summarize then, why do we believe Lotus is well positioned for the next uranium cycle? Well, as I've said, we are a proven producer. We've produced 11 million pounds. We're in a very strong cash position at the moment. We have circa 28 million Australian dollars in the bank at the moment. Some of that is restricted, about 13 million or so is restricted because it is a cash bond related to our environmental liabilities. But the remaining $15 million that we have is unrestricted and free for us to use. And that is sufficient funding to see us through until the end of next year. So it covers our corporate overheads, it covers our care and maintenance costs, covers the exploration work I've spoken about, and it also covers our feasibility study as well. We believe for any potential investors or current shareholders, there's still significant value upside, and we see that through our low market cap compared to our peers. But also, I think as we start to get the results from our exploration work and from our technical studies and our feasibility studies as well, the value of Kayelekera will increase at the same time. We also have a very strong board and management team in place that has both extensive African and uranium experience. And as I mentioned previously, when you look at the amount of capital that we need to raise to restart the asset, it's relatively low. It's only $50 million. And if you compare that to our current market cap, which sits around the $320 million, we think it's going to be a relatively simple exercise for us to be able to raise that money, whether that be through equity, debt, or a combination of both. So David, that's the end of my presentation. I'm happy to take any questions.
Okay, great. Thank you very much, Keith. Very informative presentation. So we're now going to kick off the Q&A portion of the webinar at this point. Reminder to everybody online, you can type your questions into the chat box at any time, and we'll get to as many as we can. So let's start off here, Keith. Do you think that you might deviate from either of the scenarios that were outlined in the production scenarios that were outlined in the scoping study? You talked about an open pit scenario or an open pit plus low grade stockpile scenario. And, if you don't want to deviate from those, which one would you prefer?
So I think what we're going to end up with, David, is something that's going to sit in the middle. So in the scenario one, which I didn't get into too much detail in this presentation, but scenario one was the high grade option. So we looked at mining all of the high grade material from the pit. So we ended up with an 8-year life of mine, treating about 900 ppm of uranium and producing about 16 million pounds during that period, or 16.5 million pounds. And then, as you mentioned, the scenario 2 one was the first 8 years were exactly the same. We were still going to target the high grade material, but those last 6 years we started to treat the lower grade stockpiles. And what I'm hoping is that this ore sorting technology is going to allow us to convert those lower grade stockpiles that we see in the latter 6 years into much higher economic material. So we were, in our scoping study, we were assuming we would direct feed the 350 to 450 material straight into the mill. It still made money for us, but of course it wasn't as economic as if we could feed a 750 ppm material, which we can potentially get out of ore sorting. So if we manage to demonstrate the ore sorting in our next lot of test work on these lower grade materials, I would see a scenario that's probably got this 11, 12-year life of mine, probably treating the high-grade ore for 7 or 8 years, and then treating the stockpiles after they've gone through the ore sorting. That's sort of where I think we're going to be. The one proviso for that is that we were very successful on treating the actual run-of-mine material, so the sort of the 900 ppm material through the ore sorter. Should we implement ore sorting technology a little bit earlier and take that material and push it through so we can get to that 1100 or 1200 ppm that we know gives us 3 million pounds per annum? That may be an opportunity, and that's one of the things we're going to flex in the feasibility study to see whether that's a better option for us.
Okay, so really, the ore sorting technology is very important here, because you're talking about using it to increase grades of low grade stockpiles for later in mine life, but you're also looking at it to potentially increase your production rate earlier in mine life, and it maybe not by that much, but is that going to be a focus, or is it really just to keep the production rates flat and perhaps decrease your throughput rates and saving costs?
I think it's a combination of all of them. One of the things that I see ore sorting can do for us, and that's really why I'm so impressed with it, the technology itself is relatively simple. I mean, obviously the sensors behind it and the algorithms and all that kind of stuff are relatively complicated, and you need to get someone who's really quite clever to get them set up. But once they're set up for you, the machine itself is relatively simple. And why I say that is you can actually turn it up or turn it down. It's like a dial there. So for example, say if we wanted to feed 900 ppm into the unit, but I only wanted to produce an 1100 ppm product, I dial it down. And it's literally like that. I literally dial it down and I can get the number that I want. When I'm feeding through the lower grade material, say I've got something that's maybe 600 ppm or something like that, well, I say, well, I still want to get to my 1100 that I previously had. Let me dial it up now. So I know I dial the program up, so it becomes much more focused in terms of generating this high grade concentrate. So I think we can end up in a situation where we get a much more stable feed going to the plant that's got a consistent production rate. And I think that's really, really important, because you want to make sure that day in, day out, you're producing the same, you're meeting your marketing contracts, and you've got a lot of confidence that you can do that. So I think ore sorting gives us that advantage, and that's why I'm so excited about it.
Okay, great. And this isn't a radiometric ore sorting, right?
No.
It's more of based on color.
Correct. So there's two things we had to look at. So when we did the first lot of test work, we had to look at color, and we did some test work on color. And then we had to look at XRT. Now, XRT is effectively a atomic density measurement. So we know uranium is a very, very dense atom, and this stuff can actually pick that out of the rock. What we did in our second one is we combined the two of them together, and that's what we're going to go with when we actually implement the technologies. Have both sensors, both of them running together, and we'll use the outputs from both of them to make the selection. So the one reason why we didn't go down the radiometric route is that we actually think the radiometrics, in terms of the processing time, so when it sends the gamma ray, analyzes the gamma ray, makes a decision about the rock, is a relatively slow process. So therefore the throughput through the ore sorter is slowed down because it takes time for it to do the interpretation of the data. The color and the XRT, milliseconds, you've got your results back, and you can run your belt speed at about 3 or 3.5 meters per second. So you can get a very high throughput in a single unit, which of course drops down the capital costs as well.
Mm-hmm. Have you finished any trade-off studies on this? Because it really, for the minor capital requirements, it seems like a no-brainer.
It does, and we haven't finished it off. We want to finish off our test work program. We've got one more stage of test work we want to do. So as I said, the first stage, we looked at the individual sensors on ROM material. Second stage, we looked at the combined sensors on ROM material. We're just in the process now of getting the lower grade materials, plus all the different types of lithologies that we know exist on Kayelekera, shipped across to Perth so we can test all of those samples and make sure we're getting the same results on these lower grade materials and different lithologies. And once we understand that, we can get a production schedule out that talks about how many tons per day or tons per month of each of the material types we are, and then we can start to play with the ore sorting in terms of the economics. But you're right, it's a low cost item. The unit itself costs about $3 million to buy. Of course, you've got to install it, and there's a number of things like the conveyor belts, maybe the wet screens up front and all that needs to be installed. But I can see us installing a unit for less than $10 million. It's a relatively cheap cost for us.
Okay. So, regarding the other $50 million worth of restart capital that is in the study, is there much to be spent on repairing or replacing any infrastructure already at the Kayelekera mine, or is really most of the capex due to restocking of reagents in preparation for production?
There is a large component of that is actually related to restocking reagents, but there is dollars put aside for refurbishment. We know we've got to have a look at things around the acid plant. There's concerns around there in terms of maybe corrosion and all that kind of stuff that we need to have a look at. We know there's a number of motors that have to be replaced. There's conveyor belts. There's other corrosion things we need to have a look at because the plant's been standing for a while. So there's probably some sandblasting and painting. Replacement of the motors for the crushers and all that kind of stuff also needs to be done. So we're not talking huge, big ticket items. We don't need to replace a ball mill or anything like that. But we do recognize there are some dollars that need to be spent on there around some of the ancillary stuff. But just one quick comment as well on that. We have been using the main leach circuit, has been converted into a water treatment processing facility. So every single year that gets started up and operated for about 3 to 5 months every year. So we know that that leaching circuit is operational because we run it every year. So we're looking at the front end of the circuit and the back end of the circuit towards the drying more than anything else. So, and then just as a further comment, David, that $10 million that for the ore sorting would be over and above the $50 million. So $50 million is only for the refurbishment of the existing facility.
Okay, so as far as their leach circuit, it's operational, but if you're using the leach circuit as a leach circuit, does that mean you need to come in and put some money into a water treatment plant?
No, the way that it works at the moment is that the water circuit, when we're on care and maintenance, because we have to collect all of the water that falls onto the plant, onto the tailings dam, the waste rock dumps and all this kind of stuff, we have to collect that water and it all goes down to what we call our return water dams. Now, that's got very low levels of uranium in it, but the critical item is actually sulfates in it. So we cannot discharge that water to the environment. We have to put it through a water treatment process, drop out all the sulfates, and then discharge it to the environment. When the plant is up and running, it actually requires that water. So we're water negative when the plant's running, and we return that water from the return water dams back into the plant again as the fresh water source. So we don't have to treat water when we're up and running. It's only now when we're on care and maintenance that we're required to do that.
Okay, great. Thank you for that. In terms of OPEX, your C1 operating costs around $33 a pound. Can you discuss ways where you expect these to come down? What you plan to include in the DFS? I know you touched on that in several ways during your talk, but can you maybe summarize?
So there's three things that we think we can do. So we've got the ore sorting technology itself will allow us to either increase our grades. So if we increase our grades and we get to the 3 million pounds per annum compared to the 2.4 million pounds per annum we had in the scoping study, there is a significant portion of our C1 cost is fixed. So whether that be labor, maintenance, all those types of things. So we're able to dilute that fixed component further by having a higher production rate. So we're going to see that, we think, coming through. The second one is the power. So as I mentioned, when the plant was up and running previously, it was running off diesel gensets, 28 to 32 US cents per kilowatt hour to generate power from a diesel genset. By that hybrid plan that I put forward with the connecting to the grid, recovering power from the acid plant, we think we can get our costs down to about 15 or 16%. Now, power accounts for 15% of our C1 costs. So if we can halve our power costs, we should see a 6 or 7% reduction in our C1 costs. At the same time, we have a look at the acid as well. So as I mentioned, acid is the single largest reagent cost for the plant. Again, it's around that 14 to 15% of our C1 costs. There is an existing nanofiltration circuit that was put in place in the plant in the last 6 months of its operation to recover acid from the elution circuit. So it ran for about 6 months or so. It wasn't really optimized. I've brought in the vendors who installed the system to do a review for us and to tell me what they can do. We think we can recover more acid through that process and therefore be able to reduce the amount of fresh acid that we require in the system. And then at the same time, as I mentioned, ore sorting is sort of showing, but it's not definite yet, that we're actually reducing the specific acid consumption. So kilograms of acid required to leach a kilogram or a pound of uranium is less on the ore sorted concentrate than it is on the feed. And that's because we're rejecting a fair amount of calcite and silicate from the feed material, because that's how we're getting our upgrades. So those are the types of things that I think are going to improve our C1 costs. And my expectation is sort of a 10 to 15% reduction in our C1 costs. So from 33 down to $29, $28, something like that. That's sort of my expectations.
Okay, no, that sounds good. That sounds good. So, looking at the asset optimization, you said this was maybe 14 to 15% of costs as we speak. The ore sorting circuit, can that help out you on the acid side as well?
It can, because I mentioned one of the reasons why we're able to upgrade the material is we're able to reject some of the calcite and silicate rocks. Those are the ones that contain the least amount of uranium, but have got the highest acid consumption for it. So we have seen indications, and this is not confirmed yet, but we have seen indications that the specific acid consumption of the concentrate is less than the specific acid consumption of the ore. So we think there's an opportunity around there as well.
Okay, and you mentioned that the impact of getting on the national power grid could be maybe 6 or 7% of power costs as well. Would there be any other options that you're looking at? Would those help reduce power costs, or are they really more about reliability and making sure that there's no downtime in if there should be any brownouts?
I think there's a reliability issue. I think the cheapest power we can get is obviously from the acid plant. Okay, we retrofit a steam turbine on there. We can generate this 2 to 2.5 megawatts, which, as I said, is about 25% of our total power cost, and that costs us nothing. There's some maintenance cost required on the steam turbine, but the heat's already there from the acid plant. We just need to connect everything up. So that's our cheapest option. The next one is the grid. The grid power is about 10 US cents per kilowatt hour. So that's the second cheapest option for us. But again, the reliability and the availability of the grid is probably questionable, and we need to do some work around that. And then we then start to look at, well, it depends who you speak to. Is a diesel genset at 28 cents cheaper than a solar? I think solar is probably getting towards that sort of cost, and maybe a little bit cheaper if we can get some kind of agreements in place. But I think that's how we're going to get the power down, by focusing on the steam turbine and focusing on the grid power as well.
Right. Okay. And did the original Kayelekera mine come offline purely due to the decline in uranium prices, or and if so, what price might you need to restart this?
Yeah, so from our understanding and our review of the data, yes, the answer to your first question is yes. That if you look through the Paladin's annual reports, that you'll see that the cash cost that they were quoting for Kayelekera in 2012, 2013, and the start of 2014 was $35 per pound. Okay, and we know when we look at the historical price, the spot price was $35 per pound. And again, when we start to have a look at the way Paladin contracted some of the material, a significant portion, or the largest portion, of Kayelekera's product went into the spot market at that point in time as well. So therefore, we believe that the major issue why they shut down was that the C1 costs were effectively the same as the uranium price at that point in time.
Mm-hmm. Okay. Now, you've said in the past that the government is eager to get the mine back into production, but maybe not to be confused with over-anxious or unrealistic. So how is your relationship or dialogue going with the Malawi government, and what risks do you need to be considering specifically for Malawi?
So we have a very good relationship with the government of Malawi. I think it's important to point out that it's a democratic republic. They had elections last year. The opposition party came into power last year. There was a relatively smooth transition of power. We get on really well with the new government. They are slightly more business focused than the previous governments, and we're seeing that in some of the discussions that we're having with them. They are a 15% owner of the project. So Lotus owns 85% of Kayelekera. The government of Malawi owns the other 15%. So obviously it's important for them from a revenue perspective to see the plant get back up and running, because not only do they get revenue from their share, but also there's taxes and royalties and all that kind of stuff associated with it as well. In the conversations we've had so far, they've been very, very supportive. They have made an announcement to the market or to the public that Malawi's new focus in terms of their revenue focus, let's say, they were an agricultural-based economy. They now recognize that that's not working for them. The main revenue source was from tobacco, which the sales are dropping off significantly. So they've identified mining as being their new economy driver, and they're looking to support all of the mining projects. So there's 4 international companies there at the moment. I think all of us are seeing some positive feedback from the government in terms of moving forward. They recognize it's important for them, but they're not pushing it too hard at the moment. They do realize there's a lot of work that needs to be done. They realize there's things like the power we need to sort out. There's people, I mean, we're looking at employing hundreds and hundreds of Malawians on site as well. So we need to go through the selection and training processes and all those types of things. And they recognize that and understand that when we talk about our various timelines.
Okay, you mentioned labor, but any other logistical things that you need to consider, you know, access to reagents or other supplies, transportation?
Yeah, so I've actually just tasked a company to do a logistics study for me for actually taking the product out. That was one of the first things I wanted to have a look at. So when Paladin was operating Kayelekera, they took the product from the mine through Zambia into the top part of Namibia and down to Walvis Bay, and they used that for the export port. Now, that's a fairly long trucking distance, about 3,500 kilometers to truck the material. Of course, there's a cost associated with that. I've tasked a logistics company, a specialist logistics company that deals with radioactive materials like uranium and rare earths and all that, to do a study for me to tell me, well, is that still the best way for us to go, or are there some other alternatives? Sorry, either can we go out through Dar es Salaam, which the port is a lot closer to us, it's probably hundreds of kilometers away from us. Can we go out through the northern ports of Mozambique, or could we even consider South Africa? So they're doing that study for me now to tell me which is the best way to take the product out and the associated costs with each. Now, when we look at bringing in material, what are the main things we need to bring in? Sulfur is one of them, and the other one is probably limestone or magnesium oxide as well that we need to bring in for the processing facility. I expect, and we'll get this confirmed with the feasibility study, we will bring that material in from Dar es Salaam. I think that's the easiest route for us to bring in. The alternative is to bring it into one of the northern parts of Maputo, take it by rail from that port up to Lilongwe, and then truck it from Lilongwe up to site. But I still think coming in from Dar es Salaam is better. So we're starting to look at those various things. And as I said, we've tasked a number of companies to have a look at those exact issues for us already.
Okay, great. Thank you. So the mine has about 38 million pounds of resources left, but Paladin spent very little effort or time or money looking for more uranium. Could you maybe add a little bit more color on your exploration upside, and when might we see some results announced?
Yeah, so as I've mentioned, we initiated a 5,000-meter RC drill program about 2 months ago or so, primarily focused on the uranium exploration. Now, this is all within our existing mining license. So whether that be at these radiometric anomalies that we've identified that are about 2 to 3 kilometers to the south of the pit, we've done a little bit of work around there, but I think where the real opportunity lies is actually extending the existing Kayelekera resource. So by looking at the block model and the geological models and all that, we've identified some extensions where we've put some holes in. Hopefully we can push the resource model out further and allow us to push our pits out. So we're doing some work around there. To be honest, I don't think it's going to be millions and millions of pounds. I think it's going to be some incremental pounds that we're going to get from it that is going to be good for us and help us. But I think where the opportunity probably lays is in our exploration work that we're planning on doing on our exploration licenses. And there's maybe 1 or 2 things to talk about on that as well. I believe when Paladin was doing their exploration work, they were focused on identifying resources that were very, very similar to what they saw at Kayelekera, i.e. a relatively high-grade resource that's maybe 1,000 ppm, 1,200 ppm, that could feed into the Kayelekera processing facility. I think that's where they were focused on it. There's one other thing that ore sorting does for us, I believe, is that if we could find a large, lower-grade deposit, maybe 400 or 500 or 600 ppm, even if it was some way away from the existing processing facility, but we installed an ore sorting unit at that pit and treated the material there through the ore sorter to produce a concentrate, we could then produce a concentrate that is then economic for us to truck up to site. And I think that's also a bit of a change in the way we're going to have a look at our exploration as we move forward. So, we'd like to get some more results on the ore sorting, start to, complete our review of the historical data on exploration licenses. And as I also mentioned in the presentation, we've always got our eye out for additional ground that we think looks attractive within the area as well.
Yeah. Do you using the ore sorter, do you have an idea of what you might be able to lower the cutoff grades to, and how much more uranium you might be able to bring into the mine plan?
So if I just talk about the two different scenarios we had in the scoping study. So the scoping study in the scenario 1, where we were focusing on the high grade stuff, we got about 16.5 million pounds per annum of production. By bringing in the stockpiles, we were able to increase that from 16.5 to 24 million pounds per annum. I think with the ore sorting technology, it'll be 24, 25 million pounds that we can get out of our current 37.5 million pound resource. That's sort of where I'm thinking that the ore sorting will do. I'm not too sure whether we'll drop the cutoff grade. It's a question I want to go through in a bit more detail with our geologists and with the mining guys. We're already at 200 ppm, which is sort of the limit for the gamma tool as well that we're using for a lot for our mine planning stuff. I think if we try to go below that, I think we might end up in a situation where we're not actually getting the results that we expect from it.
Okay, great. Just to turn gears here a little bit, you've divested your cobalt project, but you plan to share on the upside there. Do you expect to do the same with your rare earth element project? And, is there a desire to focus just on uranium?
Yes, there is, definitely. There's no doubt that we're a uranium company, and that's where we want to focus. We do recognize there's some value to this rare earth. We want to try and get an idea of what the potential value could be before we go into any negotiations. Now, there is an option for them. Maybe we could develop it ourselves. But I think the more likely scenario is we'll either go into a JV with someone, or maybe we might spin it out into another company. But we remain focused on being a uranium company and a future uranium producer.
Okay, great. And I guess the last question here: have you seen a change in the makeup of shareholders or interested investors over the past, let's say, year, 18 months? Is ESG top of mind from potential investors you're speaking with these days?
It's a question that we get asked a fair amount. I must admit, people do ask us about ESG. I think we're ESG, and I mean, I'm from Africa. I realize the importance of working with communities and government and all these types of things, and we would want to do it anyway. But I do believe it gives us a benefit in two areas. When we go out and raise the capital that we want next year for the refurbishment of the plant, I think some of the funds that maybe want to contribute tens of millions of dollars, I think they want the ESG component there, to be honest, or at least it'll open up a wider range of funds or investors that we could go to get that sort of dollar. So it's important from that. But also when you read a lot about the utilities, and I'm thinking specifically of the ones in the US and in Europe as well, when they do the off-market contracts, one of the reasons why they go off-market is to try and improve their supply chain. They're looking for companies that have got high ESG scores that they can bring into their score sheet as well. And I think that's going to be important when we can go to these utilities and present a largely ESG compliant company wants to sell you uranium. I think that's a really good story to sell.
Okay. Great. Well, let's leave it there. So I want to thank you, Keith from Lotus Resources. Thank you, everybody else, for tuning in. Reminder, the Red Cloud Securities will be back on Wednesday afternoon when Tim Lee sits down with Gold Bull Resources. That's September 29th at 2 p.m. Eastern. And a reminder to sign up for our virtual Oktoberfest mining conference. We've got 73 companies confirmed over 3 days. That's October 18th, 19th, 20th. That includes 17 uranium stocks such as Lotus Resources. We also have Sprott Physical Uranium Trust speaking during the keynote on October 20th as well. Anybody can sign up for that at redcloudfs.com. So with that, have a great day. Thank you very much, Keith.
Thank you very much, David. Appreciate the chat.